If you're already a day trader, you're going to feel right at home here. And if you're brand new to options, stocks, or trading in general, this is probably the best place that you could start, because this strategy doesn't rely on perfect timing at all. It doesn't rely on catching breakouts, and it definitely doesn't rely on staring at a chart all day. Now, I consistently average 3 to 5% per month running this strategy, and that is more consistent than most professional traders. And I'm doing it with significantly less stress and risk per decision. Now, for context, the S&P 500 average is about 10% per year, and I'm doing that in a few months. Not by gambling, I'm not chasing momentum, I'm certainly not day trading, but getting paid to buy stocks that I already want. So today, I'm going to walk you guys through the only strategy you're going to be using in 2026, whether that is a stock strategy, option strategy, or a trading strategy that you want to call this. You can call it whatever you want. Overall, this is just a very, very simple strategy that you can use to make consistent returns. And we're going to use a real example that I'm in right now, which is on Dell, where I entered, got assigned, watched it drop, and I still made money through this entire process. So let's take a look at this example right now. I'll give you a step-by-step process of how this actually works, and then we'll go over an executive overview of how the strategy works from start to finish. So back in November, I liked where Dell was trading at. I saw that it was on a decline, and instead of buying it outright, I sold something called a cash secured put. And explained simply, a cash secured put means I agree to buy 100 shares at a price that I choose, and the market will pay you upfront for making that promise. Now, you can only get that if you're using 100 shares. And options work in blocks of contracts, which means one contract is worth 100 shares, two obviously means 200 shares, and so on and so forth. So the only reason you can get paid to sell an option like this is when you're using contracts of 100 or more shares. So in this case, I sold 100 shares of Dell at the 136 mark right here. Again, instead of chasing the stock, I got paid to wait for my entry. And this paid me around $200, meaning just for agreeing to buy at this level, I got paid $200. So again, for making this promise, all I did was agree to buy it right here to initiate my trade, and I got paid $200 for the week for making this promise. So what ended up happening, Dell continued to trail off and grabbed me my shares right here at this level, at the 136 level, and we got assigned those shares. Now, I know that I own the shares at this level. This was a level I was comfortable at. This used to be a great support zone for Dell, so I was very confident in this level. Dell slid from December all the way into January due to, I think this was more of a broader tech pullback. We had a lot of profit taking. There were hardware demand concerns, sector rotation, and it dropped all the way to 110 at the very lows. Now, did I panic for 1 second? Absolutely not. And this is the best part about this strategy. Even when a stock is going against you like this, you can do something called running a covered call. Now, this is a very, very important part to this strategy, because a covered call means I already own 100 shares of stock and I'm agreeing to sell it at a higher price. And just like with a cash secured put, with a covered call, you're getting paid to make that agreement and collecting a premium. So with cash secured puts, you're making a promise to buy it at a lower level and getting paid to do that. And with a covered call, you're getting paid at a higher level to sell your shares at a price that you're choosing. So they're just the inverse of each other, and it can only be done in blocks of 100 shares. That's very, very important. You can only do this when you're running this with one contract, two contracts, all worth 100 shares each. Again, even when I own the shares at this level and we are dropping like this, I'm getting paid all the way down because I'm still selling covered calls above this level of where I own the shares at. So this is the key thing that you guys have to remember here, because even though my open P&L, as you can see that the stock is doing this, that means my open P&L is also following this, right? But at the same time, with me still earning every single week selling a covered call position, that while my open P&L is doing this, my account equity in the background is doing this, because I'm still earning income in the background for selling these covered calls. So open P&L is one thing, but your overall P&L in the background is what I really care about. Remember, open P&L is temporary, premium income is structural. And this is where people get confused, because when you sell a put or a covered call, you have to choose an expiration date, and this matters a lot. You can't just do this and then, it does its thing. Like, you actually have to choose when this order would expire from. So when you sell a put or a covered call, when you choose an expiration, you can go as far out as you want, 1 week, 2 weeks, 3 weeks, 30 days, 45 days. The higher the amount of weeks, the more premium you're going to collect up front. But the trade-off is your capital is tied up for a lot longer. So now my approach is I usually sell weekly options because I'm on the charts most of the time. This is my full-time job. I do this, as a source of income. So I'm here, I'm watching, I'm reading, I understand where the market's going. I have a very good understanding of the stocks that I'm owning already. So I can do weeklies because I like precision. I can adjust my strikes faster. I can react to market conditions faster. And over time, weeklies often do collect more total premium, but there is more stress. But the trade-off is weeklies require you to be more accurate with your pricing, and there's less time for the stock to recover. So for beginners, I would suggest, if you're just starting doing this, I recommend 2 weeks to 1 month out. This is just because it gives you more breathing room, the stock has more time to move, and it just reduces stress while you're learning the strategy. Then as you gain the experience, you can start moving your strikes closer and closer. So all I'm saying here is if we started on a Monday and I said we have a weekly expiration, meaning it expires at the end of the week with a cash secured put at this level, that means if Dell expires at or below this level in the next week, that's when I get the shares. If it was a month, that means I would have a month where if Dell was trading above it and then we ended up coming to or below it in the next month and stayed there when it expired, that's when you get the shares. So now this is the cool part that I wanted to show you guys, specifically this example that I'm currently in. Dell is now trading back at about $124 a share from all the way down from 110 and obviously 136 where we own them at. Why the bounce though? AI infrastructure demand is stabilizing, broader tech sector is firming up, earning stability has also been pretty good, and overall risk appetite is returning to the market. So now instead of just selling at break even when we inevitably get back to this level, I'm not just going to sell it at break even. This is where it gets even more fun to do. I'm going to sell something called an in the money covered call, or what I like to call getting paid to exit the trade. This has to be broken down very, very clearly because an in the money covered call is just something we're doing, like I said, where a covered call position is when you own 100 or more shares and you're agreeing to sell at a higher price. So you can do this even when you're in drawdown on the trade. You can sell a covered call at this level even though you own the shares up here. But that's not profitable for anybody. You're taking a loss on those shares. But in the money means we are trading above the share price. We are at or above the share price. Out of the money is below the share price. So these are the two key factors here. When I'm talking about in the money, that means we are at my share price or higher. And if I'm talking out of the money, we are below my share price. So an in the money covered call, this is when premiums are jacked to the tits. So with an in the money covered call, basically you're just agreeing to sell it where you've already are in profit on this stock. Think about this as real life trading. If you're agreeing to sell it, somebody else has to buy it. Think about if we were trading at the 145 level right here and someone is picking up your shares at the 136. That's essentially what it is. Someone is buying your contract that is at 136, even though we're trading higher. So it is a little bit confusing, and you guys should, obviously do a lot more reading on this. I can make more videos specifically about this topic, but that's essentially how it works. You're real life trading that contract. But when you're in the money, like I said, your premiums are absolutely inflated, meaning that if you owned at 136 and you're selling it at 144, you're getting paid a lot of money. I'm talking probably like $500 just agreeing to sell it at. With a covered call specifically, you're not just selling for that premium gain, you're also selling the stock gain. So if we sold at 152, that means we are getting a 10.63% stock gain, as you can see right here, and we would earn that premium gain as well. So not only are we earning just that premium, we're earning stock gain as well. So even when I go break even on the trade, when Dell inevitably comes back to my break-even point, I'm still going to wait because I want stock gain and I want premium gain. So choosing a level where I make like 10% is usually ideal for me, where a swing trade would make sense in the first place. But I've made money all the way on the way down, and I'm making money all the way back up, and now I'm eating triple the amount when we're in the money on this, and I sell that covered call position at 151, and when Dell hits 151 and expires there, my shares are going to be called away, and I earn the stock gain. So whatever, 137, I would earn 10% on the 137 to 151, and I would earn that probably $500 premium right now. So again, you're earning stock gain and you're getting that premium gain because you're agreeing to sell 100 shares or more. So the best part about this strategy is that this works in all sorts of market conditions. So one, if you sold a cash secured put, meaning we said, hey, if the stock drops to 116, we will buy 100 shares. So if we see the support level right here on Dell at 112, if we put a cash secured put right here, we'll put CSP. This is a level that we like. This is a support zone. This is a level where we could say, hey, I'm comfortable owning it at this price. Now, if the market drops, we are going to be assigned at this price. But now you're assigned at a price that you chose. You own a stock that you already wanted to own at a lower price. You keep that premium that you got from making that agreement, and now you turn into income generation just by running covered calls. Now, if we still have that same cash secured put and the market stayed sideways, say we just went into like a bit of a sideways price action for the next little bit, your option will expire down here. You're going to keep that premium that you made. Say the premium was $200. You're still going to get paid your $200 and nothing happens. So say your expiration was for 1 week. That means Dell has 1 week to move either above or into your cash secured put zone. And if the market is just trading sideways for that entire week and doesn't come to your level, you're just keeping that premium, you're not getting any shares, and you just repeat that exact same thing the next week at a higher price or the same price if we're trading sideways. Now, on the contrary, if the market continues to move up with that same cash secured put price, again, your option will expire, you keep that premium, and your capital is freed up. Now, again, you just repeat this at a higher price if you like another level to own it at. Now, for the reverse, with selling covered calls, if the market were to drop as we did right here, you would just keep selling covered calls here. So you're just still collecting this income and you're reducing your cost basis overall. If the market was, say, trading sideways at this share price, so something doing like this where we're below the covered call position still, again, the calls would expire, you're still collecting that steady income every week you do this, and then you're just repeating that process every single week until we inevitably hit that covered call position. And lastly, if the stock does go up for that week or those 2 weeks, your stock gains value, your calls will get exercised, meaning your shares will get called away. You're still keeping the premium, you've still kept that stock gain, and you've exited the trade very cleanly. So up, down, sideways, there is always a plan, and that is the edge with this strategy. Now, I know I'm making this sound absolutely amazing, but you guys have to remember there are considerable cons to any kind of trading style, and specifically with this one, you actually have to like the stock. If this is not a stock that you like, and you're just selling cash or puts because you like the amount you're going to get for premiums, that is the worst thing you can do. You're going to be stuck bag holding. This is what causes traders to take losses, because if it's a stock you don't like and it drops 30%, you're not comfortable owning it at a price like that. I can hold a stock even if it's down 50% because I've done my research and I like the stock. So that's going to be the first one. The next is going to be, you have to be okay holding through volatility. You know, the market does have its downtimes. The market does have its crashes, just like we've seen the last few weeks as well, especially in tech. You have to be okay with holding through that and understanding that you are still generating income while the market is dumping. And at the same time, you have to be confident in the picks that you choose, and you have to be done and versed very well in the stocks that you have chosen. And finally, you have to diversify. If your whole portfolio is in tech, you are essentially screwed. You're way too exposed. You have to have some structure to your portfolio, because sometimes some stocks will be doing this while others are doing this. You know, like if you have good picks and they're diversified, you'll never really be assigned shares, or your entire portfolio will never be exercised on these cash-secured puts. And remember, you guys have to very, very much remember that one contract is 100 shares. So if that is a $130 stock, that's $13,000 tied up. So if that's your entire account, you are not diversified at all. You know, you have to have a lot of structure here. You cannot be reckless with your account balance and getting super excited with premiums. But overall, the cycle of this strategy is you sell a cash secured put at a price that you like. If you are assigned, you know, if we weren't assigned on this, we would just keep that money and move on. But in this case, if you were assigned the shares, you own them calmly at the price that you chose. Next, you're going to start selling your covered calls. And all you're going to do is wait, no matter what the stock does, you know, unless there's absolutely horrible guidance and the stock is absolutely going to zero, that's when, you know, you're kind of cooked. But essentially, you know, the assumption is every stock that you choose is going to be a good pick. It's going to be an educated pick, and it's going to be a pick that will be around in the next 10 years doing very, very well. So the next step would just be running covered calls all the way until you're going to exit via an in-the-money covered call where you would exit with a stock gain and a premium gain. And you're just going to repeat that. You know, I run probably 4 to 5 cash secured puts per week. And then essentially if 2 of those get assigned, you know, those 2 stocks are running covered calls all the way until I exit, while again, I'm just running another 3 to 4 cash secured puts again the following week. And again, I'm always staying very diversified here. My portfolio, you know, functions as a, you know, regular portfolio as it would, even with cash secured puts. Even if I don't own something, everything is still very, very diversified. And that is the key here. You want diversification. You want that safety net. You don't want to be bag holding at any point doing this. I've seen negative $1,000. I've seen negative $25,000 on my open P&L. But the point is, in the background, while my open P&L might be doing this, my balance equity is doing this, because I'm still earning income when the stock's going up, down, sideways. And remember, the S&P average is about 10% per year. Most traders struggle to hit that even consistently. And this allows me to aim for that 3 to 5% per month without needing perfect entries. There's less stress, less screen time, there's more structure. This is a strategy where I'm teaching you guys long-term wealth. I'm not teaching you guys how to leverage your mom's house on call options. If you want that, go subscribe to any other guru day trader, but this is a place where you're going to learn consistent income and wealth building in the markets. This is the only strategy you're going to need in 2026. If you guys found value in this video, make sure to leave a like, subscribe, and we'll see you guys the next one.